With what could be blue smoke and mirrors on the deficit coming out of Washington, D.C., I am still very worried not only about the debt ceiling, but a downgrade by the credit rating agencies. How catastrophic might that be? Here now is Dave Goldman, former head of fixed income research at Bank of America, and Dan Mitchell, Cato Institute senior fellow. Dan Mitchell, a lot of these numbers are not real. I mean, some of it on paper looks okay. You got money market funds, pension funds, insurance companies. How bad would a downgrade from triple to double A be, in your judgment?
I don't even know whether the downgrade would matter as much as the fact that we are heading toward Greek-style fiscal collapse. That's the key issue. Whether Moody's and the others acknowledge it today, next week, 1 month from now, unless we fix the fiscal mess of overspending in Washington, it's only a matter of time before this happens. And you probably saw Larry Lindsay's column in the Wall Street Journal about what happens if interest rates begin to creep up. That's what we should worry about, not, yeah, Moody's will recognize it, they won't recognize it. Who cares? It's going to happen at some point.
All right, so Dave Goldman, I mean, look, it doesn't look good coming out of Washington right now. Maybe they'll pull a rabbit out of that, maybe they won't. For example, money market funds, a gigantic source of banking. 97% of their assets are held in AAA treasuries, which could become AA treasuries. What does that mean? Does that mean they're going to have to start dumping to preserve the value of their funds? What would that do to the banking system? And would there be a freeze up for interbank lending?
It means exactly what the regulators want it to mean. This is political. It's not automatic. Remember in 9/11, when the physical systems to clear trades were damaged by the bombing, the regulators put in unlimited amounts of credit. There was no financial crisis. And, Japan had a downgrade to AA in 2002. They're still borrowing 10-year money at 1%.
But are you saying that this kind of crisis, the Federal Reserve will have to sort of QE3, QE4, they'll have to open up the discount window?
They'll just change.
They'll have to guarantee deposits?
No, they'll just have to change the rules to say anything that comes from the U.S. government, even if it's cold AA, will be treated as a AAA.
Just like that? Dan Mitchell, would that pass muster? The regulators can just wave a magic wand and say ignore the ratings?
I have no doubt that regulators and politicians will do whatever it takes to try to keep the damage at a minimum. What concerns me a lot more than what the regulators do and a lot more than what Moody's does is what's going to happen as it becomes inevitable that we're heading off a fiscal cliff, the combination of entitlements and demographics. It's going to happen. I don't know when. If I knew when, I'd be a billionaire. But it's going to happen.
Well, it could be in 2 or 3 weeks. Could be in 2 or 3 weeks.
Dan is right, but I think Rudy Giuliani was exactly right to say that 2012 is the key. The 2012 presidential election is a referendum on the economic future.
I am worried about getting through August of 2011. I want to ask you some more stuff. I'm not going to let you off the hook. You're doing politics. I'm doing sheer raw. Insurance companies own a ton of treasuries. Pension funds own a ton of treasuries. Mutual funds own a ton of treasuries. If the rating is dropped, they're all going to have to take a value and price haircut. What happens to their valuation? What happens to their pension obligations? What happens to the people that own the stuff in there?
Larry,
they're all going to get damaged.
That's a political issue. When I hear Obama's guy, Larry Summers, saying it's going to be Lehman on steroids, what I worry about is that Obama will try to engineer a crisis and blame the Republicans for it and say,
I know, but what is the crisis entail? I mean, Dan Mitchell, states and localities depend on the AAA rating of U.S. Treasuries. It's a very important part of this story. In fact, today there was a story. A bunch of states like Tennessee and Virginia and New Mexico and some others all risk their own downgrades because of a federal downgrade or a miss of a federal interest rate payment. What do you make of that? This could jeopardize the states as well as the others, the mutual funds, the pension funds, and the insurance companies.
The key thing isn't the downgrade. It's the fact that the value of these so-called assets, the government bonds that people are holding, if they go down in value, that's when everyone gets in trouble.
That's the ultimate haircut, Dan. You're right. Yes, that's the ultimate haircut.
And we've all heard about the sovereign debt bubble, but 99% of us don't know what it means. That's what it means. It means that there's a rush to the exits. And remember, what happened in Ireland, in Greece, and Portugal, and other European welfare states, there weren't a lot of warning signs. It happened not quite overnight, but it happened very fast.
All right, I'm going to give you the last word. story quickly. The overnight interbank lending market, which froze up in September 2008, that stuff is backed by AAA treasuries, too. What happens if you get a haircut from a downgrade? You could have a freeze.
You could if you have an actual default. The computer systems can't handle a default. If there's an actual interruption in payments, all bets are off. Then it's like 9/11, where they have to open the monetary floodgates to prevent the system from completely crashing.
We got a lot of treasury bills and treasury bonds rolling over in
Yes,
August.
That's correct. If you don't roll it over, then there's a catastrophe, which is why I've been trying to tell the Republicans, do not push this into a default, because then Obama will act like a socialist dictator and try to revise the system by emergency.
All right, those treasuries roll over pretty fast. I got to get out, gentlemen. Thanks very much, Dan Mitchell and David Goldman.